Every investor has to make a choice. Do you want short-term profits or long-term growth? Because you run a company very differently depending on which one you're optimizing for. And make no mistake, Tesla is in growth mode. Today, we're unpacking what that really means, why margins might look lower now, but the upside is massive, and how smart investors should think about Tesla's long-term game. If you're in it for the next quarter, this isn't for you. But if you're in it for the next decade, listen closely. Cern Basher is a chartered financial analyst running his own investment advisory firm called BrilliantAdvice, providing wealth management services. Welcome, Cern. Thank you for doing all this work today. After the earnings call yesterday or 2 days ago, that was the big theme, wasn't it? It was this loss of fundamental numbers and the metrics year over year. Looks like it was terrible. It was down. But actually, there's a bigger story behind, right? Tesla is in growth mode. They're betting big on what's to come. They've got the cash. Maybe they do, maybe they don't. We'll talk to you about it. Thank you so much, Cern.
It's good to be here, Herbert. Yeah, I think there's a big distinction between the two types of companies that we're going to talk about today. And I think it's important for investors to think about that distinction.
Tesla's in growth mode. Okay. And so you're going to compare, what does it mean when a company's in growth mode? And what does it mean when a company's maximizing for short-term margins? So what is this we're looking at here?
This is an actual photo of, I believe, a Falcon 9 launch. And I used it as a metaphor for what could happen with Tesla's revenue and earnings growth at some point in the future as they get through this growth mode and make the investments they need to make. This is a metaphor for the financial impact on that. As we've talked about before in our most recent valuation episode we did about a week ago, the opportunity for autonomy and humanoid robots is enormous long term. It's this messy part now, this investment part that is makes it a bit challenging in the short term.
So just to clarify, at the earnings call, Q2 earnings call, you weren't phased at all by any of the numbers, whether they're up or mostly down.
No, again, as we showed in our valuation show, that the present value of any quarter or any 1 year's earnings is actually pretty tiny in the total present value of a company, right? Assuming the company survives and is somewhat successful, any one quarter just does not matter. It matters a lot to Wall Street because they're so short-term focused, and they're comparing revenues and earnings and margins to the last quarter and a year ago, and they complain about no growth, but they're missing the bigger picture.
Love it when you say that. That's why I asked you to say it one more time. Okay, let's go.
So here's, again, there's a case in point. Here's Tesla's quarterly revenue now since 2012. And so you can see that, starting from the left there, pretty steady upward progress. There have certainly been a few plateaus in Tesla's history. They look relatively small now, but they reached the, $5, $6, $7 billion mark and kind of stayed there for a little bit. And then they broke through that, and now we're at the 25, 20 billion-ish mark, and they've been stuck there now for quite a few quarters. And so for a lot of people on Wall Street, they think that Tesla is a broken company. It's a no-growth company. It's not going anywhere, right? And that's really what they're hyperventilating about. But as we'll see as we get through this presentation, I think they're missing the bigger picture here.
Do you have a slide that carries it out from 25 to 2030, and then we see what happens to revenue, where this is like really down below, like here?
Well, we did that sort of in our valuation show a little bit. I'm more focused sort of on the concepts in this show. Perhaps we can extend it at some point. But the next slide smooths out some of these quarterly ups and downs. But still, it's very clear that Tesla has reached this plateau where they're trying to get above 100 billion in revenue. And they just haven't done it now for, in a couple of years. They were knocking on the door there in Q1 of 2023. So it's been a little while. Perhaps that's Q2. I think Q2 of 2023, they were approaching 100 billion, and it sort of felt like they would cross that fairly quickly, but they didn't. And then if you look at net income, again, this is on a quarterly basis, so it's quite lumpy. And you can see that net income, became positive, and it was on a good track, and then it's really stalled out. 2 quarters ago, it was as low as 420 million. There was one quarter there where it was almost 8 billion, but that was some deferred taxes that impacted that. So no great trend in net income. So what's really going on here, right? So let's try to answer this question. So as an investor, kind of at the two extremes, you've got a choice to make. Do you want your company to optimize for short-term profits, right? Do you want to milk that cow?
Hmm.
Or would you prefer that the company build for growth for this big future? And in Tesla's case, it's products that don't even exist in the world yet, right? Autonomous vehicles, there's very few of those in the world. Tesla has big ambitions in that area. And then humanoid robots. And again, there's a number of companies working on that, but these are two big real world AI ideas. And you can't just flip a switch and say, okay, we don't have those, and now we do. There's an investment period that you have to go through to get from where we are today to this bigger, brighter future. And so when you listen to people talk about Tesla and all the negatives, think about this little image here. Most of the criticisms are kind of about optimizing for short-term profit. They complain about margins, and they complain about pricing, and they complain about short-term strategies of advertising and doing this, that, or the other thing. And while I don't disagree that Tesla should do some of that, what I'm here to say is that don't lose sight of the much bigger picture. I would rather have Elon and his team focused on the challenges of AI and scaling their efforts there than trying to figure out how to move current customers to use more FSD or buy more cars or whatever it might be. And again, none of that's negative, but if the choice has to be made, I would much rather Elon and the team focus on the growth opportunity that doesn't exist today, right?
Mm-hmm.
Ideally, we'd like to have both, but in reality, it's probably too much to ask for.
Yeah, it's coming. So a couple points I want to make. So first of all, it's coming because imagine we're struggling in the auto business this year. It'll struggle next year. If FSD truly does work and it becomes a demand driver, you can sleep in your car while it's driving you somewhere. That's going to make cars skyrocket again, maybe 50% growth again, very likely, as well as cybercabs. So volume of cars could actually get back to the 50% growth. We're going to be in a scenario sometime where we're getting revenue from robotaxi, revenue from robots, and revenue from auto as well. But I want to come back to just a quick point. I just had a show with Larry Goldberg, and we're just reminiscing what it was like a year ago. You remember a year ago, there was a huge argument, a huge debate with so many people, mostly institutional analysts, who would say, like Gary Black was saying, Tesla should be buying back stock. You should be paying 5 billion, 10 billion, buying back stock. Look at the stock. Look where it's at now. Tesla has enough money. You can do both. You can build factories. You can grow your company, but you can also give back stock. Now, today, we are sitting here with Robotaxi launched, and the investors, analysts were asking the question yesterday, where are you going to get the money to scale Robotaxi? You need to build 100,000 cars. You need to build 500,000 cars because it's here. Like, you're going to have to expand this as fast as you can around the world, or you can get that money. And Tesla responded saying, well, good thing we have a balance sheet. We have 37, he didn't say this, but he said we have a balance sheet, $37 billion in cash, but we also can now raise debt through debt once you have a business running. So now they have to think, I need money for Robotaxi today. I need money for AI data centers. I need money for robots. Yeah, so it's a good thing. Very happy that they did not spend that money on cash, on stock buybacks.
I believe that we are entering a world where companies that aggressively bought back stock are going to regret it because they will need the capital that they gave back to shareholders.
But of course,
they may find it increasingly difficult to raise that capital in the world that we're headed into.
You would rather them bought Bitcoin. That's another show.
We'll do another show. But yes, but even holding cash, in my opinion, would be preferable. Again, short-term profit maximization, buying back stock. Yes, I agree. If you want to maximize short-term profits and share price in the short term, definitely buying back stock. But I think we're entering into this new world. Right.
Apple's been buying back stock like crazy. Stock skyrockets, great, but where is their AI?
Yeah.
I don't know if maybe they're separated because they are certainly making so much money because they made a growth bet and that growth bet paid off. I love the next two slides. I absolutely appreciate you putting these together. Let's walk us through.
Yeah, these are fairly simple, but I think enough maybe to get the points across. So if you are maximizing short-term profit, here's a little checklist. Keep your capital spending low. right? Limit it to essential maintenance to keep the plants in operation.
Hmm.
Keep your R&D expenses low, right? Don't go into any crazy new ventures. Just little incremental improvements. iPhone 15, iPhone 16, just incrementally improve. You got a good thing going, just keep it going. Keep your SG&A expenses low, right? Selling, general, administrative. Cut stuff, just try to manage that as best you can. Keep your stock-based compensation modest. What's the point of paying up for the greatest AI researchers in the world? Don't let somebody else do that. Just keep a decent team in place, right? You don't have to pay them with stock, just pay them with cash. Raise prices maybe a little bit to boost margins. Focus kind of on pricing, right? And then most importantly, for goodness sakes, don't let your CEO rock the boat. Put a muzzle on the guy and don't let him, jeopardize anything that you're doing. Just stay under the radar, give money to both parties, try to keep everybody happy, maximize short-term profit. And this is the game that Wall Street wants every company to play. Okay, great. What we're going to get with this is no innovation, no world-changing ideas. Okay, and thankfully, we have many companies in the United States that go a little bit against this grain, but not completely. But in Tesla's case, we have a company that goes completely against this. So if you were to build for growth, you want to spend a lot on capital spending. Now, it's not just about spending money. It's about intelligently spending money. And we've seen with Elon, he gets a lot of value out of each dollar spent. Google and Amazon and Microsoft are spending way more money than Tesla can, but they don't seem to be keeping up with what Elon can do with the money he spends. You also want to spend on R&D, right? You want to create new disruptive technologies. You want to grow your team. You want to build a great team. So your SG&A, is going to go up, even during a time perhaps when your earnings and revenue are kind of flat. And Wall Street hates that, but you know what? You need to build a team. And then stock-based compensation. You need to build a team. You need to attract talent. They want stock. They want the growth potential. The problem with this approach is you're going to have a lot of shareholders that become dissatisfied because the short-term results leave them wanting, right? But the reality is, this is what you have to do if you're building for growth. It's painful. I mean, Elon takes a lot of slings and arrows for his approach. Maybe he could communicate it better. I mean, I could find fault with how he communicates at times. I think sometimes the way they conduct their earnings calls could be a lot better. And I think many of us have ideas for how Tesla could do that better. But the reality is, at the end of the day, they're doing what they should be doing. Could they do it differently and better? Perhaps, right? Again, no one's perfect. They're going to make mistakes. There's opportunities they're going to miss. That said, I do believe they have a great team. I do believe that they do listen to feedback from people. We've seen that many times. And so I think they're trying to adapt as much as they can in this changing world. And of course, that's the other thing, right? They're faced with all these headwinds that are really sort of hurting the short term, whether it's tariffs, whether it's the EV credit for consumers going away, and all these things are creating massive headwinds for the company. But in the face of that, they are still investing heavily for this future.
And I would imagine it's also, you would invest ahead of need. Like they would build superchargers before they, need them necessarily. They would build lithium plants because they knew that they were going to run out of it in the future. Like thinking ahead and getting something built and run now before because you knew that's going to come.
Yeah, I mean, I would imagine in retrospect that Elon probably wishes that they would have secured their own supply of LFP sooner than they have.
Yeah.
Different things like that, right? If they could have thought through everything and seen the future, I think that Tesla would be even better positioned than they are today, perhaps even more vertically integrated.
Well, I think the big example is the decision that Elon made, very well documented at the Walter Isaacson book, where he basically said, yeah, the future is autonomy. We're going to bet the farm on autonomy. And I don't think we need to have a Model Q sub $25,000 car. His executives talked him out of it. Turns out Elon was right again. He probably doesn't need a sub $25,000 car because autonomy is here, and what they really needed was a cybercab, purpose built for robotaxi. Now they're still going to do a sub $25,000 car, a sub $30,000 car, but he was right. he made that decision. So he already reinvested a lot of money, like basically doubled down on autonomy, and it paid off. Like it actually is here now.
So the good news is we have a recent company and recent history here with a company, NVIDIA, that kind of went through a similar transition.
Mm-hmm.
Here's NVIDIA's revenues through October of 2022. Now, I think you would say this is a pretty good chart. There's a couple of dips here, right? There's the dip sort of before COVID. COVID really energized the gaming chip market. People were staying at home. They bought a ton of gaming systems. So that really energized the company during COVID. And then there in 2022, they had a bit of a fall off and revenues came down. And so investors were really worried about this. In fact, it sent the stock price, from over $30 a share on the next page down to a low of about 11 by October of 2022, kind of the low point. Even though Jensen was talking about the AI wave that was coming, investors were so focused on the existing legacy business of gaming chips and gaming systems, they just couldn't see past what was happening with the company on an operating basis in the short term. So fast forward a little bit, Herbert, on the next page. Here is what NVIDIA was doing with their R&D.
Mm-hmm.
Now, NVIDIA doesn't have to worry about CapEx too much because they have other companies that make the chips. So R&D is their big thing. They were investing heavily throughout this entire period. If they wanted to maximize short-term profits, they would have cut their R&D way back to try to salvage some respect from Wall Street, right? If you want to keep short-term profits up, then cut these discretionary expenses of investing in AI chips. Please, Jensen, please, let's beat the earnings, right? They didn't do that to their credit. And they paid a price for it in the short term. The stock again went from the 30s down to 11. Shareholders were screaming.
Mm-hmm.
All right. The next page here is the SG&A. Again, continuing to invest in building the team. All right. There's a couple of down quarters, but not many there. Right. So again, to NVIDIA's credit, they powered through. And that's what you have to do. If you're going to get from one side to the other and there's, alligators in the pit in the middle, you better just go through there as fast as you can. Keep investing, get to the other side. And that's basically what NVIDIA did. And then if you look on the next page, here's what that meant for the revenues. That little blip that we saw in the first screen chart is right there where your cursor is. Look what's happened since.
Mm-hmm.
And again, I remind you, I've said this so many times, Jensen was telling everybody what was coming. No one listened, and most investors missed this move, at least the early part of it. And look what's happened to them. They were a $6 to $8 billion revenue per quarter company, and now they're over $40 billion per quarter. This is the opportunity that Tesla has in front of them as they get into this autonomous world, robotaxi, and then eventually humanoid bots. This is the opportunity that Tesla can go after. No one talks about NVIDIA's gaming chips anymore.
Mm-hmm.
Now, on the next slide, look what happened to NVIDIA stock. Went from 11 now to 172. A few bumps along the way, but that's a pretty good chart right there. Investors will come back. But did they need to exit the stock? Not really. If you would have bought at 30 and you now hold it at 172, are you upset? I don't think so. Right? You suffered some pain in the short term there for, a year or so.
Mm-hmm.
In Tesla's case, the pain's been a little bit longer. The transitions have been a little bit tougher for them. Real world AI is a tough problem to crack, right? It's not easy. So let's look at some of the same metrics then for Tesla. Here's their quarterly SG&A. It's pretty much going up. From time to time, Elon has made some staff cuts to try to trim expenses and keep things lean. That bright orange bar there in the middle is Elon's compensation plan when the company had to pay $340 million in taxes for his exercise of his options. This is what's tied up in the Delaware court right now. So that's why that one's so high. Otherwise, it wouldn't have been such a standout. But this is a company building for the future, as evidenced by growing SG&A. Let's look at CapEx and R&D. Tesla is a much more capital-intensive company than NVIDIA is. They actually build plants and make things, whereas NVIDIA doesn't. They farm that out. So CapEx is huge for Tesla, and R&D also is pretty large. Now, CapEx is capitalized. They don't expense that as they build a plant. They put that on their balance sheet as an asset, and then they have to depreciate that asset over its useful life. So that doesn't affect earnings in the short term, except for the depreciation charges that come along. But R&D is an immediate hit to earnings. Again, if you were managing for short-term profits, you wouldn't grow R&D in this way, right? You would reduce R&D to preserve profitability. In the last quarter, their R&D here was 1.5 billion, okay, which is way more than the company earned in profits. Like they could have more than doubled their profit if they wanted to, if they just would have cut R&D. Okay, so again, indications the company's building for a bigger future. All right, if we add CapEx and R&D together, in the most recent quarter, Tesla spent about $4 billion. It's their third highest quarter ever in terms of CapEx plus R&D spending. The other two were 2 and 3 quarters ago.
Do you know where the CapEx is? Are we talking about the data center, Cortex? Or are we talking about, because there's
we'll get
no
there in detail
Gigafactory.
in a minute, Herbert. Yep,
Okay.
we'll cover that.
Yeah.
Now, Q1, I think there was a little bit of management going on because it was such a bad quarter for auto sales because of the Model Y changeover.
Yeah.
So they used some discretion and pushed things maybe into Q4 and then in this latest second quarter. So that's fine. There's some management of the company's resources and cash going on there. That's prudent. But still, it was, approaching 3 billion in spending. It wasn't like they dropped it to zero. I'm sure they would have preferred not to have delayed some things. And then just to give perspective, on the next page is Tesla's cumulative spending on R&D since 2012. It's now north of $25 billion. And you can see this just going up, over time. And then if we look at CapEx, their cumulative capital expenditures are north of 50 billion. Spending a lot of money, again, to build out capacity and infrastructure for these new businesses. And we'll get into the specifics here in a second. And then if you put the two together, the CapEx plus R&D, the total combined investment's approaching $80 billion. By the way, Tesla's total lifetime revenue this quarter in Q3, I believe, will reach $500 billion cumulative.
Mm-hmm.
Okay, so they've taken now 80 billion of that 500 billion and reinvested it back into the business. Right, it's phenomenal. Let's now look at cash flow. Operating cash flow is one of the most important metrics of any company. You're looking at the actual cash of the business. It's taking basically the operating income of the business and adding back some non-cash items or taking into account other things that don't affect income but actually affect cash, like growing inventories and things like that. It's a little complicated and we won't get into it here, but the point is, ideally, you want to have operating cash flow cover your CapEx needs. And you can see that in recent years, with the exception of, I believe, one quarter, Tesla has always had operating cash flow that exceeded their CapEx. And the one quarter that was the exception was when I think they had the Red Sea issues where they couldn't go through the Suez Canal, had to go around the Horn of Africa. It lengthened the time to get vehicles to Europe, and they lost sales in that quarter, and they made them up in the next quarter. What I'm trying to show here is that Tesla is a very well-managed company. They've got the cash resources to meet their CapEx needs, and they're doing a nice job of managing that in what is a difficult environment for their auto business. So that's been a challenge for them. It's not like they can just spend whatever they want on AI infrastructure. They do have to manage within the confines of their business. So in my opinion, they've done a nice job in doing that. In this latest quarter, the cash flow is just slightly more than their CapEx.
Do you have a table on free cash flow?
I didn't include it on here. It would simply be the difference of the green versus the blue. So free cash flow for Tesla actually has been pretty strong, with a couple of quarters where it's been small or negative.
You can see that Tesla purposely made sure that the green was a little bit above the blue this quarter to have free cash flow. He didn't want to go negative. And Elon has said before, right, hasn't he, that free cash flow is the metric to determine whether or not a company is viable, whether it's a successful company or not.
Yeah, in the short term, you can go free cash flow negative as long as you've got ways to fund the business. But for a company that's Tesla's size, I think that would give Wall Street some fits. So it's better if you can to be self-funding, self-sustaining, and not rely on outside capital.
Yeah.
All right, you're not at the whim of the market either. So it's better to be in control of your own destiny there. Yeah. So a minute ago, I mentioned that if Tesla wanted to optimize short-term profits, they could slash R&D. This chart kind of gets at that picture. I stacked R&D on top of the operating cash flow. right? To get kind of an image of what it might look like if they didn't spend so much on R&D. If you just added the two together, that would be your new operating cash flow. And this latest quarter and the quarter before that, for the trailing 12 months, they would be at record levels, right? Which is amazing because everybody thinks that Tesla is this horribly performing company. And yet on this measure, they're basically at all-time highs.
If Tesla decided not to do any R&D, they would be killing it. It would be like people freaking out how much money, cash that they're getting, but they're spending on R&D. But a lot of the big companies, they spend even more on R&D.
Well, it becomes easier when you've got a mature business. Like Apple's business is throwing off so much cash, right? So it's different. I mean, they're all different phases of their life cycle. Tesla is in a later phase in the auto life cycle, but in a super early phase in robotaxi and Optimus. And those businesses, if you looked at them on a standalone basis, are not cash flow positive at all. The autos are supporting it, and increasingly the energy business as well.
Yep.
But I just wanted to give this perspective. This is actually, in my mind, actually a very important chart just to show how strong Tesla really is on a cash flow basis. If we assume that they're not a growth company, if we're just putting everything, we're just maximizing short-term profits. If they wanted to, this is what it could look like.
I also like the idea that it's not just growth in one extra new business. It is many different businesses, right? We're talking about autonomy, robots, energy, AI, and then, of course, even a bunch of other businesses that they might get into, like AI data centers and Dojo. That's another one.
That's right.
Every one of these is like, Tesla has a business like NVIDIA.
Yeah.
They're building it. It's incredible.
Yeah. And we'll only know in the future just how profitable, what the return on that investment will be. But I think it's going to be pretty astronomical. And again, we're in the investment stage right now. Any company that wants to grow has to go through an investment stage. You've got to develop the product first. And then, only then, can you get the revenue and the profit from it. The revenue and the profit are the last things that come. Right. What we're looking at is the precursor.
Are you gonna talk a little bit about that point you just made now or later, or you want to just, if not, then I'd like you to remind us what you just said right here.
Yeah. Again, this is I think a critically important point. I'll just say it again. Any company that's a high growth company has to go through an investment phase. Typically, that investment phase means negative free cash flow, or very little cash flow, very little profit, heavy investment in R&D, heavy capital expense if it's a capital-intensive business. The result of all that is revenue and earnings at some point in the future. But that's the last thing that shows up. If you want to see what could be a high-growth business, look at what they're doing now. Are they making the investments in all these areas to get to that point where they can produce revenue and cash flow? That's really, as a growth investor, what you need to be looking for, not whether they're doing it now, not whether they're earning the revenue and profit now. If they are, then you probably missed the first big move in the stock because investors are going to discover it well before it happens. Now, in Tesla's case, this investment period has kind of been lengthening out. And so investors were excited about it, and then they lose faith, and the stock has kind of gone up and down. In my estimation, based on what I see, it's still coming. It's getting close.
Yeah, that's a very, very powerful point that you just made there. If the revenue and, would you say revenue and margin or cash?
Revenue and earnings, cash flow, yeah.
Revenue, earnings, cash flow are the last to show up. So you can't get that if you didn't do investments. And if you didn't, if you don't do investments, then you might still look good on the balance sheets and everything looks great, but yeah, you're making bets here.
I mean, to use a sports analogy, if you want to win at Wimbledon or any big major sporting event, you better put the training in. So look for the companies that are doing the training.
Yeah.
Right? It's that simple. Now, not everybody is going to be a standout winner like NVIDIA has been, but that's what you need to look for, companies that are making those investments. So in Tesla's case, then, let's take a look at the investments they're making. This is the investments in property, plant, and equipment. So this is the capital expense that they would have to depreciate down over time. And I've got it listed by quarter. Unfortunately, the quarters don't show up here. I apologize for that. But the one on the far right is Q2 of this year. That's the most recent quarter. And then each one towards the left is one prior quarter. So Q1, Q4, Q3, Q2, and then Q1 of 2024 is the first one on the left. I believe, again, I'm sorry, I didn't put the quarter headers on there. Oh, sorry, they show up on the next page. But anyway, we'll get there in a second. All right, for the most recent quarter, their total spending on property, plant, and equipment, or the total balance there is 2.6 billion, and the accumulated depreciation is 1.1. So a total of about 1.5 billion. Okay, but you can see they spent 700 million on machinery, equipment, and vehicles, 376 million on land and buildings, AI infrastructure, $750 million, $750 million. Tooling, 150 million. Leasehold improvements, so existing buildings, adding, making changes there, 234 million. Only 7 million on computer equipment. Construction in progress, 426 million. So spending heavily in many areas. And then the next page, which actually has the headers for the quarters, shows the balances in each of the categories. So they've spent a total of 19.5 billion on machinery, equipment, and vehicles. 11 billion on land and buildings. AI infrastructure now is a $6 billion spend. 4.5 billion in tooling, leasehold improvements, 4 billion. Computer equipment, 3 billion, and construction in progress, 7.7 billion. 56 billion of total spend. Depreciation has been about 18. So current on the books value, asset value of about $38.5 billion. Now, these numbers are great. Let's make it a little bit visual on the next page. It takes the same numbers and just plots them out with different colors. The AI spend is in the brighter green. So it's gone from 1.5 billion balance in December of 2023 now to over 6 billion.
Per quarter. This is a good number.
This is the total. This is not per quarter. This is the total spend.
Total. They spent 6 billion. Okay.
Yeah.
Total.
Right. And you can see the depreciation schedule there in the little box on the top left. A little hard to see, but for AI infrastructure, it's 5 to 30 years, depending on what they've spent money on. So that, they have to depreciate that down over time. And some of the other things like the building and building improvements is a 15 to 30 year depreciation schedule. So, there's a hit to earnings on all these at different points in time. But Tesla continues to spend. Point is, Tesla continues to spend a lot of money in lots of different areas for growth in these areas, particularly autonomy. And then we'll start to see probably more spend on humanoid robots, particularly building a factory at some point, or putting equipment into existing spaces, perhaps initially. And then the final chart, Herbert, is the quarter-to-quarter changes. And you can see the red is construction in progress. And so as they're building a building, and then when it's finished, that's a negative. It comes out of that category. So it looks like to me that from September of 24, that they finished, maybe this was Cortex 1, they finished that, it came out of construction in progress, and then got booked into potentially the AI infrastructure category. Again, I don't remember precisely what it was, but that's how that might flow. Okay, so think of it as different accounts within their capital spending. Again, we could stack this up against a number of other large cap tech companies, and you'd see that they're spending more than Tesla.
Mm-hmm.
But it's what can Elon get out of every dollar spent? And I think he's already pretty famous for being pretty capital efficient, right? And also being able to get work done very quickly. Jensen Huang, I think, has been very complimentary of Elon in terms of spinning up the XAI data center and how quickly they did it there. Elon's speed is second to none, and that applies to Tesla as well. So that's it, Herbert, in terms of the charts. This one, by the way, shows. Sorry, while we were there, that one shows that Tesla is approaching the 500 billion revenue mark, and I think they'll probably get there in Q3.
Cumulative. Mm-hmm.
Yeah, cumulative revenue.
And that's the one that will show up after all those investments that you do. So that's eventually, right. That 500 billion, you've mapped out several shows we've done where you forecast what the robotaxi revenue could become, what robots can become. Those were, the gold after you put in the work. So
that's right.
It's going to be a step change.
Yeah. So my wrap up thoughts around all this is it's very easy to get negative about the quarter, for sure. The auto business is finding itself in a challenging spot, right? The global auto industry is struggling. It has been for a while. There's competition. There's, you can call it brand damage if you want, whatever headwinds Tesla is facing there. combined now with the fact that you've got tariffs and you've got the EV credit going away and that type of thing. That's a major headwind for the auto business. But it's very clear the future of Tesla is not in that business. The sooner they get away from that and start to generate revenue in their AI businesses, the better off they will be. And it's a little bit like taking your medicine now for a better future. And unfortunately, we're taking the medicine now. Right. And we have been for a while. This is not just this quarter. I'm just saying that over time, it's because Tesla is such a capital intensive business, it just takes time. But they're making the investments that they need to make. Could they be doing things better and faster? Maybe. But by all accounts, I think they're doing it about as well as you could expect.
Mm-hmm. I think there's different kinds of Tesla investors, right? I find it interesting that people invested in Tesla when they got the car. There's a huge group of people that discovered Tesla after they bought the car. They thought, this is such a fantastic car. I think this car will go skyrocket. So I don't want to generalize, but of course, a good group of them really think of Tesla as just a car company, right? Whereas I invest in Tesla after I've invested in Apple, where I'm looking for innovative, disruptive companies. That's the kind of investor I am. I'm looking for a company that is spending money on R&D, that is just going to invent something that if that thing succeeds, it's going to totally disrupt an entire market, like just upend it. And the market is so big that number one, multiple competitors can succeed, so I'm not as worried. But two, it is so big that it's like one of those bets where, okay, as long as I don't lose my money, like this company may not go bankrupt, then I'm feeling worth, okay, maybe it'll just go up by 10% like every other investment, or it can go 10x. That's the one I'm looking for. So here, if this company was not innovating, meaning that they're investing in R&D for autonomy, for robots, for AI, that's where you go, okay, yeah, it's a car company. It's still going to succeed, but it's going to go through challenges. You know what I mean? Like there's some people that for some reason, like they invest in Tesla. And I've been saying I've been saying, you really have no business investing in Tesla. When I see what the kind of comments that they make, they're more value investors. They're really wishing that the stock would go up by 10% each year. And they would, like you said at the beginning, they would criticize everything about the company because why is the stock not going up by 10% this year? Because your revenue is not going up by 10% this year. Why aren't you advertising? Why aren't you rolling out a new kind of car that's going to generate another 10% of sales? Whereas Elon's like basically, what matters more is autonomy. If I overlay autonomy to all my cars, it's game over for every car out there. My car's not a car. It's a,
Yeah, if you think about it, what's happening here is we're invested in a company that represents two things: an auto company that's a public company that has every right to be a public company, but attached to it now are these venture capital investments, right? And if they were separate, they would not be public enterprises. Right. And so that's the problem now. We've got public company shareholders that are owning this venture capital and multiple venture capital investments in this public company that makes them very uncomfortable because they're not used to investing in those kinds of businesses that have a long time to get to the point where they can produce revenue. And it's kind of the 100x or zero kind of situation. And most public company investors, they're not used to that kind of level of risk. And here in one company, we've got it combined. And the public company part has struggled, but it's successfully funding the new ventures. They don't have to go to the venture capital market to get funding. It's coming from the public company. And just that push and pull between the two of those, you can see it every week, every quarter. That's what's going on here. And that's really difficult for a lot of people.
That's well articulated. So yeah, let's just repeat again what I think you thought, what you said is the most important part of this whole thing. Tesla is in growth mode, right? And so if you're in growth mode, you're going to be, where's your thing one here? Yeah. You're building for growth and not optimizing for short-term profit. So in your mind, you've been saying this for a while, the quarterly earnings can go up and go down. It's going down. And so it's looking terrible. Yeah. It's too bad, but it's not the thing that matters to you. What matters to you is you're looking at the growth investment and whether or not that's going to bear fruit. And that's why the robotaxi advancements, if they're expanding it, that means that they're heading more likely chance that these massive revenues will come later. Continue to invest in AI infrastructure, continue to invest in robotaxi. And so you're okay. You feel like there's enough cash, $37 billion, to fund the robotaxi program as they want to scale as fast as they can. 100,000 cars, 200,000 cars.
I do. I was actually surprised in the earnings call to sort of, I mean, they're right about this. They said that, when you have a business model, you can get debt financing, like the Wall Street will fund it. So that's not an issue. But Tesla can self-fund it. And by the way, robotaxi is pretty self-funding itself. These cars
That's what I'm asking you. So in your models, you do feel like it'll flip at one point, but very soon, where it's actually going to be cash flow positive, not a negative, right?
Yeah. I mean, these vehicles, let's say you make the Cybercab for, call it $20,000. It's easy for those vehicles to generate $100,000 a year initially.
In 1 year. Yep.
Right. That's in revenue. So the vehicle can pay for itself in just a matter of months. 3 months minimum or maximum. Very easy for Tesla to self-fund that growth.
Wow. Okay. Yeah. Because they did say, where are you going to get that $5 billion from? 37, they might spend $5 billion on robotaxi scaling. And then at that point, they'll do debt.
Now, what I would argue is that Tesla should put a chunk of that $37 billion into Bitcoin and use debt to fund the growth. And then to get the best of both worlds, cheap cost of capital, and then a treasury asset that's appreciating over time.
Yeah.
Now, again, that's adding a whole nother element to this public company, making people very uncomfortable. So, while that may be right on paper and conceptually, the reality of that maybe doesn't fit with what Tesla is doing today, at least until it becomes normal practice for companies.
Isn't that the story of Q2? The story of Q2 just now was Bitcoin kind of saved the day. Bitcoin appreciation is what kind of flipped the story a little bit, isn't it?
Yeah, I think most analysts ignore that. They just see that as an asset that goes up and down. The first quarter it was negative, the second quarter it was positive. And unless you understand what's happening with Bitcoin, you're just going to, like regulatory credits, you're just going to ignore it. You're just going to wave your hand and say, we're just going to take that out. Yeah. Great
show again. This was the most important thing to discuss with the Q2. A lot of misunderstanding. Tesla's a growth company. That's what we're seeing. So, if you're negative about it, ask yourself why you're negative. Is it because maybe you're negative because you felt that the Optimus has been sandbagged a bit, or not sandbagged, I'm sorry, delayed, prototype only this year. Yeah, that's fair. That's fair. But anything else with auto, shouldn't be that worried about it. Yeah. Good. Thank you so much, Cern. Always great work, timely information for us. Appreciate you. Follow Cern on his X account, Cern Basher. Subscribe to him there as well. Thanks, everybody. Bye-bye.
Thanks, Herbert.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.